Hello, Avila Finance students. It is November 11th, 2018, and hard to believe we are already halfway done with the course. So just make sure to wrap up everything you need to do for today for Sunday, to get the exam in, the homework problems. This week we're going to start again with the forum discussion, so do make sure to jump in there by Wednesday because that gives you time to allow to post some posts to your peers, and then you'll have the homework this week. And this week, we're looking at chapters 10 and 11. So we're going to get a little bit more detail and some calculations here. But these are really good tools to have and understand for any business that you're in and trying to determine whether we should take on a particular project or how we should really devote our time and energy and resources. That's going to give us the biggest bang for your buck, if you will. And then chapter 11 looks a little bit more detail about trying to forecast those free cash flows because cash, bottom line, is king. So, all right, let me start a little bit of discussion about chapter 10. There's first one you're going to look at is called the payback period. This is a very simple calculation. If someone out in the field is saying, hey, we need a new warehouse, we expect the warehouse is going to give a return of X cash flows over a number of years. All you're doing is say if the warehouse cost $1 million and you're getting $250,000 back each year, well, after 4 years, you would cover that initial cost. It's a pretty simple way to do it, and it doesn't deal with a whole lot of difficult math. Something easy for someone out in the field to understand, but it's lacking in the sense that it doesn't take into consideration opportunity cost. And that's where you get into the use of net present value. So with net present value, we're making an assumption that there's some initial cash outflow. I'm going to get future cash flows in from a project. We keep this pretty simple and that these cash flows nicely occur at the end of each year, but in reality, we know that doesn't happen. So someone that's in finance, that's an analyst, just has to estimate that, what it would be for those free cash flows in that time period. Then, of course, based on that weighted average cost of capital we talked about, you're discounting all those future cash flows back to find out what the present value is. And as long as the net of these differences, that is the present value of the cash flows, is greater than the initial cost, we would accept the project. Because by that way, we're covering both our explicit and explicit cost, and we're adding value to the company. If the net present value is negative, it's still possible it's earning an accounting profit, but it's not making a profit that meets our investors' opportunity cost. And so that's why we want to look for projects that are going to increase value. And you have to be careful with that sometimes because people may pitch a project that gives a very positive net present value, but does it add a whole lot of value to the overall company? It's a small project. Is it just making the manager look good and not truly adding value to the company? Two more that you're going to look at are called the internal rate of return and the modified internal rate of return. The internal rate of return, the simplest way to think of this is it sets the net present value exactly equal to 0. So you're trying to look for that interest rate, and that's why we let Excel or calculators do this. But if thinking back to like the net present value problem you may have in the book, if I kept on raising the required rate of return on a project that had a positive net present value, eventually those present values are going to keep decreasing as the interest rate keeps rising. Kind of go back to that thing we talked about with bonds. And it's saying, hey, at some point as I keep raising this interest rate, the present value of the cash flows are exactly going to equal the initial outflow. So that's what we call the internal rate of return. And it's a way to look at like a hurdle rate. So if I have an internal rate of return of 17% and my required rate of return is 10%, I would say, oh, okay, let's approve this project. So it beats my hurdle rate. Problems with that, though, again, is, net present value looks at the actual value added. We may mistakenly take on certain projects that have high net internal rate of returns but don't bring a lot of cash flow to the company. So we got to be careful with that. Last is the modified internal rate of return. The textbook talks about the problem that, hey, we may have some projects that have this initial cash outflow, future cash flows that are positive. At the end, we may have a negative cash flow. So that you do a quarry and you're digging out a bunch of rock, and the town says, hey, when you're all done with this, you got to turn this into something else. One that's been turned into a golf course. Others sometimes are filled with water, and scuba divers use them. But there's a negative cash flow at the end, so that creates different internal rate of returns when you have that problem. So an alternative is the modified internal rate of return. So I want you to think about it this way: is that first you have to find out what the present value of the free cash flows are. And that is possible, let's say those future years, 1, 2, 3, 4, whatever it is, even the last one would be a negative cash flow. But you can still discount that back as negative cash flow. As long as your future cash flows are greater than that last negative cash flow, we would still take on the project. But then we have the next is the terminal value, and that's the future value of all those cash flows. So the calculation is basically saying that, hey, if I have this terminal value of flows, and I'm trying to set that equal to the present value of those outflows, there's some interest rate that's going to make those hold equal. So that's what you're trying to find. That helps you determine the project. Our Chapter 11 gets more into having you think about true cash flows. They gave some examples about you got to think in terms of actual cash flow, not accounting. Accounting, we may book something in the books, say this December is coming up, and maybe some things are sold on credit. Well, that's counted in that year, but we don't actually get the cash flow until January, so we have to be cautious with that. There's also, say that you invent some type of new razor, call it the Schick 7, and you have a Schick 6. Well, you got to think about erosion of that Schick 6 razor compared to the Schick 7, okay? So that you got to be realistic with those cash flows, because probably people are going to be switching to that new type of razor, and you're going to lose some over here, so you have to take that into consideration. Also, sunk cost just goes back to economics. If you had that class, the sunk costs are sunk. You do not consider that in the project decision. Also, ignoring how you finance any project, any interest associated with it. We just really want to know about the return on that investment. And then also, to think about working capital. A lot of people forget about working capital, that when I start a project, I'm going to have to devote some monies up front, inventory, other expenses, whatever it is to start the business. My family and I went to this Texas Roadhouse and Lease Summit, about a month ago, but it requires a tremendous amount of money just to get that restaurant off the ground, starting to have some inventory and supply. So you got to remember to factor that in when you're making your decisions. But the primary basis of this chapter is to look at how they calculate free cash flows, because ultimately that's, think back to Chapter 10 in net present value, where do they come up with these free cash flows? So somebody had to estimate them. So it's looking at the true free cash flow. So I would spend a lot of time looking at page 380, because that gives a good example of how they come up with these cash flows. And that's what analysts use to kind of break it down to find out what the net present value is. Last thing, just to wrap up with this chapter, I think is very beneficial, and they talk about sensitivity analysis and scenario analysis. Sensitivity analysis, I want you to think of it this way. Let's say that you're Southwest Airlines and you've done all these net present values for the particular route that you're looking at, and then all of a sudden one of the key leaders says that, I want to know if jet fuel costs go up 20%. How does that impact the project? I said, oh, okay, we can look at that. And then you could redo all those numbers. And he may say, I want to know what happens if all of a sudden the union says that the pilots demand a 20% raise. How does that impact the project? So what you're doing is you're just changing one variable at a time, and then see what the resulting net present value is. So it gives the decision maker something to think about that says, oh, okay, the project's still profitable as a positive net present value. I see the risks that are associated now. I want to go ahead and take on the project. Because again, with any project, no business or any project is guaranteed for these cash flows. Things change in the environment all the time. Amazon is doing very well right now. Toys R Us is not. Okay, so it's tough to project those cash flows. The last is probably ties more to scenario analysis, and that's taking in, the reality is that usually it's just not one thing changing at a time. It can be many variables changing at a time. So that might use something called like a Monte Carlo simulation, It looks at that bell-shaped curve and looks at the probability of all these different events happening. Is the economy doing well? Is the economy rough? How is our industry doing in this economy? So it gives the decision makers some more reassurance. It says, well, okay, at least I know that if there's an 80% chance based on my number crunching that this project will still be profitable. Again, nothing guaranteed, but the scenario analysis can help decision makers with the what ifs, and that's a big benefit. So, all right, well, I look forward to talking to you online, so you'll have a great week, and we'll talk to you soon.